Hey everyone, and welcome back to the channel. Today we're diving into a massive shakeup that just hit the stock market and rattled thousands of investors. We're talking about Hims & Hers Health, ticker symbol HIMS, whose stocks just plunged 30% in a single day. This wasn't just a minor pullback, it was the company's largest one-day drop ever, triggered by the sudden collapse of a high-profile partnership. On Monday, Hims shares fell 28%, dropped another 25% in pre-market trading to $47.90, and crashed 32% during intraday moves. At one point, the stock was down nearly 23% from its previous close. This collapse erased billions in market value and sent a clear message to Wall Street: something big just broke. The bombshell? Pharmaceutical giant Novo Nordisk, the maker of blockbuster weight loss drug Wegovy, terminated its recently announced partnership with Hims & Hers. This collaboration was only revealed back in April, when both companies said they were launching a long-term roadmap to expand access to Wegovy through Hims' telehealth platform. That announcement had said Hims stock soaring 23% in one day, driven by investor excitement over the booming GLP-1 weight loss drug market. But now, just 2 months later, it's over, and for reasons that go well beyond business strategy. Novo Nordisk's statement was damning. They claimed Hims & Hers had failed to comply with federal laws prohibiting mass sales of compounded drugs. According to Novo, Hims was marketing personalized GLP-1 drugs, like semaglutide, the active ingredient in Wegovy, that were in fact illegally compounded knockoffs, produced in bulk and marketed as custom formulations. Worse, Novo said many of these drugs were sourced from unregulated suppliers in China, suppliers that had never been FDA inspected and had even been flagged for quality violations. The FDA has not approved the manufacturing process or the drug quality of any of these foreign entities. Novo's U.S. Executive Vice President Dave Moore pulled no punches, saying, "When companies engage in illegal sham compounding that jeopardizes the health of Americans, we will continue to take action." Novo Nordisk made it clear they expected Hims to pivot away from compounded formulations and towards their FDA-approved drug, Wegovy. That didn't happen, so the plug was pulled. Since the deal had been set up through a third-party pharmacy, Novo won't owe Hims any termination fees. This move is directly tied to a recent FDA update. As of mid-May, semaglutide is no longer considered in shortage. That means compounding pharmacies can no longer legally produce unapproved versions of it, except in rare cases involving allergies or special dosages. The FDA generally allows compounded alternatives only during official shortages. Novo Nordisk recently won a legal case supporting this change, reinforcing its exclusive right to manufacture Wegovy. That ruling dealt a regulatory blow to companies like Hims that had relied on compounding loopholes to gain market share in the white-hot GLP-1 space. Hims & Hers CEO Andrew Dudum quickly responded, accusing Novo of misleading the public. According to Dudum, Novo Nordisk's commercial team pressured Hims to steer patients exclusively to branded Wegovy, even if it wasn't the best clinical fit. He claimed this would have violated provider autonomy and prioritized profit over patient care. Dudum said Hims would continue to offer a variety of treatments, including personalized semaglutide doses and branded Wegovy, based on clinical needs. He framed Novo's decision as a competitive attack rather than a safety issue, stating, "We refuse to be strong-armed by any pharmaceutical company's anti-competitive demands. The health and wellness of individuals always comes first." This isn't the first clash between the two companies. Hims had aired a Super Bowl ad promoting its compounded GLP-1 offerings as cheaper alternatives to Wegovy. In response, Novo launched a campaign titled "Check Before You Inject," warning patients about unsafe, non-FDA-approved versions. For investors, this isn't just drama, it's money. GLP-1 drugs had become a key growth driver for Hims. In Q3 2024 alone, revenue from weight loss offerings jumped 90% year over year, accounting for over $225 million in sales. Analysts projected earnings to grow 36.5% annually over the next 5 years, with sales increasing 58.5% this year and 22.6% next year. But now, those forecasts are under threat. Citi analyst Daniel Grosslight said the termination raises Hims' legal risk substantially, expressing concern that the original deal didn't address compounding practices. Investment bank Needham downgraded Hims from buy to hold, citing increased risk and uncertainty. Despite all this, Hims stock remains up nearly 82% year to date, thanks to strong performance earlier in the year. But it's also extremely volatile, with over 94 trading trading days of 5% plus moves in the past year. Market cap dropped to $6.56 billion, and share volume exploded. Some estimates say over 55 million shares changed hands, nearly double the average volume. The stock now trades at about 41 times next year's earnings, which some argue is too high given the uncertainty. Some market watchers suggest applying the 3-day rule here, waiting 72 hours after a surprise crash to reassess. The idea is to avoid buying during peak panic or chasing a falling knife. While Hims is now a high-risk, high-reward stock, its core strengths remain: a powerful direct-to-consumer telehealth platform, deep brand loyalty, and strong reach across categories like men's health, mental health, and dermatology. In fact, non-weight loss segments made up 40% of revenue in 2024. But now, the company needs to prove it can sustain growth in the GLP-1 space without relying on compounded drugs or partnerships like NovoCare. GLP-1 drugs remain one of the most sought-after opportunities in medicine, with analysts projecting the market to exceed $150 billion globally by 2030. Wegovy, Mounjaro, and Zepbound are already dominating headlines and reshaping obesity care. For Hims, the challenge is breaking into that market legally and sustainably, especially as regulators and big pharma increase their scrutiny. Analysts like Michael Cherney at Leerink noted the terminated deal was fundamentally at odds with Hims' desire to keep selling compounded drugs. Without Novo support, Hims may struggle to fill the gap. For now, Hims will continue to sell branded Wegovy on their website, though not as part of bundled membership plans. They may also double down on expanding their other health verticals while exploring future GLP-1 partnerships that align with evolving regulations. Interestingly, Novo Nordisk also had a rough day. Shares were down around 6%, partly due to this fallout, but also due to disappointing results from its CagriSema trials, its next-gen weight loss treatment. The drug showed weight loss averages of 22.7% and 15.7% over 68 weeks, missing the 25% goal. Plus, competition from Eli Lilly's Mounjaro and Zepbound continues to mount. Novo has tried to fight back, recently slashing Wegovy's price by more than 50% to stay competitive. The company says it will continue to work with telehealth providers that prioritize legal compliance and safety, and has pledged to continue fighting illegal compounding with the FDA's support. So where does this leave us? For Hims and Hers, this was more than a lost partnership. It was a massive credibility hit, raising questions about its compliance practices and long-term business model in a tightly regulated market. Yet, the company still has powerful assets: a fast-growing platform, strong customer base, and experience scaling telehealth services. The big unknown is whether it can pivot fast enough to stay competitive in the weight loss space without the legal baggage of compounded GLP-1s, or will it fall behind as the market consolidates around major players with FDA-approved drugs? Time will tell, and we'll be tracking every development. Thanks for watching. If you found this breakdown helpful, don't forget to like, subscribe, and share for more financial deep dives. See you in the